Now, global equity markets have been marked by volatility over the past month due to growing concerns about the Fed's policy stance, especially tightening, leading to a recession. Stocks have sold off as a result, with MSCI All Country World Index declining by more than 16.6% year-to-date, and the S&P 500 and Nasdaq Index falling by 16% and 25% year-to-date, respectively. Now, much of the downward pressure on equities have stemmed from stickier-than-expected inflation, leading to concerns about the Fed's over-tightening as it attempts to move back in line with the curve. As such, the path of the markets and risk sentiment going forward hinges on the Fed's battle against inflation. Now, April CPI was starting to show some decline on a year-over-year basis to 8.3% from March's 8.5%. However, the month-on-month change was still higher than expected. Looking ahead, the price of transitory components such as used cars, gasoline prices, and commodity prices are starting to begin to wind down. Shelter inflation could also slow down, as 30-year mortgage rates move past 5% will likely soften demand within the housing market. As we go into the second half of 2022, a moderation in inflation should help to boost risk sentiment, as it would provide a reason for the Fed to tone down on its hawkish stance and ease concerns about the Fed being behind the curve. Now, there are already some suggestions that the central bank hawkishness is starting to fade. Fed Fund futures currently pricing in 50 basis point hikes in both the June and July meeting at 88%, but this could return to a more moderate 25 basis point increase in subsequent meetings. Investors are also worried about growth headwinds elsewhere in the world. In China, the resurgence of COVID-19 has impacted on both domestic demand and export activities. China's April PMI, or Purchasing Manager Index, showcased a slowdown in both manufacturing and service industries due to lockdown measures. In Europe, the war in Ukraine continues to push up input costs, with surging prices dampening consumer sentiment and slowing the region's growth. Now, having said that, we think that downside risks to growth in China and the US are less alarming. In China, improvement in the COVID situation would give the economy a much-needed reopening boost, along with policy stimulus. Concern over growth in the US is also relatively premature, given that continued strength of corporate balance sheets and also domestic consumers. Now, what does that mean for investors? To hedge against inflation and growth risks, investors should consider quality companies offering historically more stable earnings growth and also ample pricing power to protect against the impact of inflation on profit margins. Exposure to energy, industrials, and material stocks also makes sense given the support for commodity prices due to the continued shortfall of supply relative to demand. The recent derating of equity multiples due to higher real rates may also provide investors a fresh entry point given how stretched equity valuations have been over the past 2 years. In particular, long-term investors may want to add IT or information technology exposure, as valuations in the sector have moderated substantially. Selected tech companies should see strong earnings growth over the long run, given secular demand for software products and services, as well as ongoing demand for hardware. For income-seeking investors, the current environment also warrants a revisit to the fixed income space. The recent widening of corporate credit spreads has brought fixed income to attractive territory. In addition, corporate fundamentals remain healthy and corporate default rates are expected to remain low as economic growth stays positive. Investment-grade bonds provide a good balance between income generation while remaining resilient at a time of economic volatility.